All right. Today is Sunday, June 26th, and this is a recap for the stock market activities last week and an outlook for the week to come. Folks, I got a good one for you tonight, but I got some bad news for you. Are you excited for the upcoming 4th of July holiday? Perhaps going to the lake? Fireworks, barbecues. Well, we got a problem because this time around we have a shortage of mustard. Yep, and rumor has it the supply could not catch up with the demand. Anyhow, apologies for the absence the last few days, but it was a hectic week for yours truly. But the good news is we'll be back on track this upcoming week. Without further ado, here it is, in focus tonight. Buy the dip or catch a falling knife, because it appears that we have sucker's rally on our hand. A lot of folks in a few days are going to believe that this is the bottom. You're going to hear, and you're probably hearing it already, a lot of talk about peak inflation, the bottom is here, the Fed doesn't have to tighten as much, yada, yada, yada. And this will be yet another sucker's rally. But in the meantime, can you play it? Do you play it? The answer is yes, via call options, of course. And we're going to look at different charts and options plays in this program. But we're not buying the dip for real. I'm not buying the dip. If anything, I'm dumping stocks in my portfolio, like I'm on Pepto-Bismol. But why do we say that the bottom is not here yet? Because we have a lot of indicators. Now, let's start by this. This year so far is seeing a lot of 2% plus rallies per day. And this is yet another indicator that we are indeed in a bear market, although a lot of the Wall Streeters, the smarty pants, the so-called experts, some of them still believe that this is a correction, an overreaction. This is not a real bear market, even though we've been in a bear market since what, the beginning of the year? But here's the problem with these bear market rallies, specifically the one that we have right now. A lot of folks, specifically the retail mom and pops and the so-called experts, are saying that this is a good time to buy the dip because the sentiment is so bearish, we've never seen such bearish readings before. And this is a contrarian indicator that we should buy the dip. But here's the problem. Every time the bears take over the bulls in the ratio, in this indicator, after 16 weeks from that takeover by bears, we get some decent rallies. For example, back in 2010, we got a rally for about 10% after 16 weeks from the takeover by bears in the bull to bear sentiment ratio. Likewise, in 2011, after 16 weeks, we got a 9% rally. 2015, we got a 7% rally. And then we got a 16% rally in 2018. And in 2020, we got a 27% rally. This time around, after 16 weeks since the bears took over the bulls in the bull to bear ratio indicator, the S&P 500 is actually down by about 13%. So far, it has been catch a falling knife, catch a falling knife, catch a falling knife. The dip buyers have been getting slaughtered over and over and over again. And the declines in this bear market episode have been really steep. Matter of fact, the average, per usual, 5% protection that the hedgies and the likes buy are not enough, because when you buy a 5% put, these are the monthly puts to protect your portfolio. Well, guess what? The stock market in January, for example, was down over 5%, closer to 10%. February, same story. In March, it was different. The market was actually up, but then the declines in April resumed more than 5%. Similar story in May. And then in June, the stock market keeps declining by over 5% every single month. And hence, hedging by using the 5% monthly puts was not enough. But are the declines that we got so far enough to form a bottom? Well, not really. Why? Because the retail crowd is still alive, and we know from bear market history that the bottom is not in until the retail mom and pops are done. And by done, I mean dead. Now, ask yourself a question. Are they dead when you have the stupidity of buying Revlon stock after declaring bankruptcy? You know, the bankruptcy optimism. Matter of fact, the stock of Revlon shot up by almost 500% since declaring bankruptcy. Why? Because the retail mom and pops are still alive and they're gambling on this stupidity. Instead of constructing a real portfolio for the long run, investing rationally, well, they're never going to invest rationally. We now know that for sure. So the bear market bottom is not going to be here until the mom and pops are completely dead. When they say the stock market is going down to zero, we will never go back to the stock market. That's when the bottom happens. For now, the retail crowd continues to buy stocks, continues to buy the dip, with no stop in sight, at least for now. And this is a sign, a real contrarian indicator, that the bottom is not here. But the retail crowd and the pumpers on the media and the likes from Wall Street have a few arguments here. And the most important one is, look at the commodities index, the ticker GSG, for example, and it appears that the commodities index has already topped. The bullish momentum, the bullish run in commodities is done, at least according to the retail mom and pops and the experts. And you can see that in the orange chart. Now, the blue chart is the ticker ARKK for Kathy Wood, Mama Kathy. Look at the inverse correlation since 2022 started. The higher commodities went, the higher inflation expectations went, and hence the higher the expectations of Fed tightening went. And by now, you should know that higher interest rates, meaning Fed tightening by increasing interest rates, is not good for speculative assets such as the ARKK by Mama Kathy Wood. But if the commodities index is topping, then interest rate hike expectations are also topping because inflation expectations will top. And hence, do we have a bottom in the ARKK and the speculative assets, the names that have been getting crushed since the beginning of the year, since before the beginning of the year, the high multiple names, the retail crowd, favorite names? That is the argument. Another point, they bring up the contrast between the performances of cyclicals versus defensives. Defensives have been outperforming cyclicals for the longest time in history. And the retail crowd and the so-called experts say that this is a contrarian indicator, pointing out that things are being exaggerated here and you should buy the cyclicals because they're going to tend to outperform defensives in the months to come. AKA, this is the bottom. Here's the problem. I see this as an indicator of the upcoming recession. Matter of fact, in 2008, when this indicator, the contrast between cyclicals and defensives shot up higher to this magnitude, we got a recession. So when I see this shot up higher, to me, this is an indicator that we're about to hit a recession, perhaps a severe one, and hence, it is not a sign that a bottom is in. Now, you might say, hey, Maverick, you're being too harsh on the retail crowd. Everything I hear around me is a recession is here. The stock market is going down to zero. Don't buy the dip. You see these so-called finwits on YouTube, who are really not finwits, by the way. They're just trust fund babies gambling with daddy's money. And they did pretty good when the market was easy, when the Fed was easing. And now they're all confused. What's happening? What's going on? And their channels are not doing so hot so anymore. But they're saying, now they're flipping the script, of course. They're saying, don't buy the dip. It's over. We're going down to zero. So isn't that an indicator that the bottom is in, Maverick? Isn't that an indicator that maybe we've overdone it with the selling here? Here's the problem. Analysts at Vanda Research, led by Marco Laccini, said in a weekly research note that while retail interest in U.S. stocks reached its lowest level of the year so far on Tuesday, they still have not reached levels of capitulation, quote-unquote, on par with what we witnessed or what was witnessed before stocks turned around in December 2018 and March 2020. What are they talking about? Here it is. Retail investors' inflows have reached the lowest level of the year so far, but they're not negative yet. We're still seeing inflows. We're still seeing the retail crowd buying the dip over and over and over again, getting sucked in these bear market rallies. You see, back in 2018, for example, retail inflows went negative for a few days before we got the bottom. Likewise, in 2020, retail inflows went negative before we got the bottom. But here's the problem. In both cases, back in 2018 and 2020, Jerome Powell came to the rescue. So one could argue that yes, retail inflows went down to negative territory, and this is a sign of the bottom. But you got to keep in mind that the Fed initiated the rescue back in 2018 and 2020. This time around, retail inflows could go down to negative territory, but the Fed will not be here to conduct the rescue anymore because they cannot ease anymore so long as inflation continues to move higher. So that is one caveat you have to keep in mind. Likewise, another indicator in red, and this is inverted by the way, just to illustrate for you, is U.S. household equity allocation. In green, the S&P 500 inflation-adjusted total return over the subsequent 10 years. As you can see, every time the retail mom and pop, the U.S. household starts to get engaged in the equities market and their allocations to the equities market start to move higher, significantly higher, usually it is an indicator of a bubble. Because again, U.S. households, the retail mom and pop, they get sucked into the stock market when the stock market is hot, meaning by the end of the cycle, when things start to get crazy, the last hurrah kind of rally, the bubblicious harshest period of any bull market. Yet the problem is, after the peak, the subsequent returns in the S&P 500 for the next 10 years usually turn negative and lag prior years. What does that mean? What you're looking at right now is an indicator that we are seeing a bear market, but even after the bear market, we will see stagnation. We will see a sluggish stock market that doesn't produce returns just like we saw in the past 10 years plus. And hence, is the bottom really here? What are the expectations of a bottom? Are the retail mom and pops expecting that we're going to go back to all-time highs? Because that's not going to happen anytime soon. Matter of fact, we might be heading to a sucker's rally, but we are nowhere close to the actual bottom. Why? Look at the VIX. The VIX remains subdued. Usually, extreme fear is a sign of a bottom, the actual bottom. Look at this chart and ask yourself, are we seeing peak fear? Are we seeing fear at all? Usually bottoms happen when the VIX hit 45 plus. We're not even close to 45 right now, despite the massive declines in the S&P 500 and the Nasdaq year to date. Furthermore, when we look at the skew, meaning the demand for to hedge your portfolio, we're not seeing that fear yet. Yes, the skew went higher, meaning some folks are hedging, but we're not seeing that massive pop higher that indicates extreme fear, extreme panic, and hence the bottom. You might have heard this last Friday because the Fed made a stress test for the banks, and the Fed tested for a scenario of 10% unemployment rate, a drop of 55 plus in the stock market. Now, why would the Fed do that? Are they testing for the upcoming recession when the unemployment rate indeed hits 10% and the stock market indeed falls 55% plus from the top? I certainly think so. But rest assured, Bank of America says that investors should gorge on stocks if the market falls another 18%, as the next bull market could send the S&P 500 to 8,900 by 2028. But here's the problem. If the stock market indeed goes down by another 18% and you buy the dip by both hands, with both hands, you gorge on stocks, well, the same Bank of America says, whoops, because the S&P 500 could fall another 23% in the worst case scenario as the stock market price in a 1/3 chance of a recession. So that 18% could go down another 5%. In other words, the strategists at Bank of America don't know what the fuck they're talking about. But now we got 23% downside in the worst case scenario. And it's not just Bank of America, by the way. Even Morgan Stanley says the same thing, that the stock market could fall another 23% in a recession scenario. So we got 23% from Bank of America and Morgan Stanley. Can I get a 24%? Anybody? 24%? Yep, we got Bloomberg. Bloomberg say 150 years worth of data show that the S&P 500 may go down by another 24%. Can I get a 25%? Going once? Oh, I can get better than 25%. I can get 33% this time around from Societe Generale, who say the S&P 500 could fall another 33%. What are they talking about? Here it is. Every time we have a recession, the stock market on average goes down by 33% before finding a bottom. Likewise, another study shows that the bottom is not here, not even close. Matter of fact, we have different scenarios. We have the severe bear market scenario. This is from history, of course, going back all the way to 1870. If we have a severe bear market, for example, then we're going down to the same range the stock market was trading at back in 2019. When you really think about it, the whole point from this recession is to take out the extra fluff the Federal Reserve has pumped into the economy and the stock market. Meaning, the whole show that you saw back in 2020, 2021, that was a charade. That was a fake rally, a fake pump in the economy. We have to go down back to rationale, back to reality, back to where the stock market should have been trading absent of the Fed's pump, which is around the same levels of 2019. Now, if things intensify, for example, we see a domino impact crash in the equities market due to the crash in cryptos or other assets, doesn't matter what the reason is. We see lots of margin calls. We see companies declaring bankruptcy. We see companies laying off employees excessively. And that would happen if the Fed overdo the tightening, and there is a real risk that they could do that because they've been way behind for a long time and they're playing catch up. Then we could go down in the S&P 500 even further. We could go down below the 2019 levels. Matter of fact, we can go down in a retest of the 2020 bottom after the thing crash. So again, short-term optimism that inflation perhaps is peaking after the crash in commodities, but in the long run, history says that the bottom is not here. Not even close. And when we talk about the crash in commodities as an indicator that inflation is peaking, is it really an indicator that inflation is peaking, or is it an indicator that we are heading into a recession? And if that is the case, then buying the dip becomes the equivalent of catching a falling knife. We have traders betting against oil excessively right now, betting that oil would go down in a recession scenario, not peak inflation scenario. Yes, we have talk that perhaps Russia-Ukraine might seek a truce agreement, and therefore we see oil prices going down. But the problem is, we're not going to buy Russian oil anymore, regardless whether we have a truce between Russia and Ukraine, because the West has to walk the walk. It would be embarrassing if they do a 180 and they say, okay, hey, Russia, we're friends again. We're going to buy your oil and gas. I don't think that's going to happen. So oil will only go down in a recession scenario. We talked about that in details in this channel when we talked about the 2008 scenario. When in July 2008, oil peaked, matter of fact, started to crash, and there was a lot of talk that perhaps this is peak inflation and we will see the equities market recovering and the economy being alleviated from the pressure of inflation, yada, yada, yada. That did not happen. That was an indicator that a recession is around the corner. And indeed, we got the greatest recession since the Great Depression. Usually, when we look for market bottoms, we look for the US dollar topping, we look for the 10-year yield topping, we look for oil topping, because all of these are indicators that inflation is indeed topping, peaking, whatever you want to use, doesn't matter to me. And that means that expectations of Fed tightening are also easing down. Here's the problem. Let's say the US dollar indeed goes down. From this point on, we see a top and the dollar goes down. Likewise, we see the 10-year yield topping at 3.5% and then going down. We see crude also topping and going down. The question becomes, are they going down for the good reasons or are they going down for the bad reasons? The good reasons would be a legitimate ease in inflation, meaning supply is meeting up with the demand, but you got to bear in mind that the demand is out of whack, it is irrational, and there is no way the supply can catch up with this level of demand. And hence the Fed is crushing demand in the economy using its blunt force tools of increasing interest rates. And the risk with that is they could overdo it and crush the demand so much that that could cause a recession. But sake of argument, are we seeing the 10-year yield going down along with the dollar and oil for the good reasons, meaning the supply is catching up with the demand? I don't see any evidence of that. Or are they going down for the bad reasons? The demand is getting crushed in the economy now, and the expectations are, because the markets are looking forward, the looking forward mechanisms are saying the demand will be crushed by too much, that we are heading into a recession. And if the dollar, the 10-year yield, and oil go down because of expectations of a recession, then they're going down for the bad reasons. And that is not an indicator that we should buy equities, that this is the bottom in the risk-on assets in the equities market. If anything, this is a sign that there will be more pain to come. In the meantime, looking at the oversold technicals in the stock market, we could have an oversold rally, because these oversold technicals are looking for a fundamental reason to ignite a rally. Even if it is a fake fundamental reason, even if it is chatter right now of peak inflation and the Fed not having to increase interest rates as much as we thought before, yada, yada, yada. That would be good enough for a rally in equities, specifically the oversold ones, the risk-on ones. But then reality is going to hit again. This economy is heading into a recession, and equities are not going to do good as the economy heads into a recession, and hence, it's not the bottom yet. Keyword yet. And with that, folks, let's move on to cover the stock market activities last week for you. And we start with the performance of indices, and here we go. On Friday, the Dow Industrial Average was up by a stunning 823.32 points, or a gain of 2.68%. The Nasdaq up big by 375.43 points, or a gain of 3.34%. By the way, look at the relative volume in the Nasdaq. What does that say? Lots of inflows by the institutionals, by the retail mom and pops. This could sustain a rally for a little while, so watch out here both ways. If you're a bear, watch out for a big bear market rally. You don't want to get caught in that. If you're a bull, watch out. You don't want to get caught in a bear market rally and then you find yourself with your pants down when the bear market resumes. Anyhow, the S&P 500 was also up on Friday by 116.01 points, or a gain of 3.06%. The sector's performances on Friday, in the green, all of them, no shame here. We're not going to shame any sector of the market because they all closed in the green. But at number one, capturing the gold medal is communication services. Number two for the silver is cyclicals. Number three for the bronze, technology. Let's contrast that with the performance for the week. Here it is. All in the green with exception of energy. Energy down big big along with materials, hence the commodities trade is down. We're seeing that little rotation to technology and the risk-on segments. But at number 1 for the week were cyclicals once again. At number 2 for the silver, REITs. Number 3 for the bronze, communication services. What about the advance to decline ratios on Friday? The NYSE, 83% advancing versus 15% declining. The Nasdaq, 65% advancing versus 31% declining. Commodities, what's going on here? We got a rebound on Friday for crude after being down big. Both the WTI and Brent went higher and scored gains of almost 2.75% apiece. And then we have the RBOB, gasoline, still holding on, and it gained about 3% on Friday. You want to see the RBOB below 3.5 before you start to see easing of the prices at the pump. Right now, we're closer to 4. Who's to say that this rebound is not going to last? And we see the RBOB back above 4% again. And then we got muted gains for both the heating oil and natural gas for a little under half a percentage point apiece on Friday. Yet natural gas is down big since the top. It's down by almost 50%. We discussed the reason why regarding the Freeport LNG facility. Now, let's talk about some energy news here, because the Biden administration appears to be going along with the tax holiday at the pump. And this could actually be bullish for energy prices. Why? Because taking away the federal taxes on gasoline prices, that will give you a relief of about 18 cents at the pump per gallon. That's kind of negligible all in all. But regardless, the psychological impact would be, oh, taxes are going to go down on gas, so I should pump right now. And we have the 4th of July holiday coming up. Lots of driving, lots of action at the pump. What is that going to do? If we have a little dip because the federal taxes are gone for a little while, well, that kicks in the aggregate demand because consumers are going to say, let me pump now before prices go higher again. And what happens is the demand increases and that pushes gas prices higher again, perhaps even above the levels they've been trading at before the tax holiday. So watch out here. This could backfire and push energy prices higher again. Of course, this is expected by the genius BlackRock administration. This is what happens when you let these former BlackRock advisors handle the economic policy of the administration. But anyhow, when it comes to natural gas, while prices here in the United States are going down, prices in Europe are actually moving higher again. And the reason is the Russians are now squeezing Germany. The Russians say we can't pump natural gas via Nord Stream 1 because we're missing parts that we need from Canada. And Canada is slapping sanctions on us. We can't buy the parts, and therefore no gas to Germany. And this is becoming a massive problem because the Germans placed all their bets that they can play tough against Putin and Russia because they got the US behind them. And they're not going to have to worry about natural gas anymore because we're going to supply them with liquefied natural gas. Well, now that the Freeport facility is gone, the Germans have to scramble for supplies. The Russians say, no more. We're done here. And this is becoming a problem for the German economy, to the point where they have to declare an emergency. Matter of fact, the Ministry for the Economy says that the whole market is in danger of collapsing, that this is a Lehman moment if Russia indeed cuts gas supplies to Germany. They don't have the time to prepare. They did not have the time to prepare for such action, and the entire economy of Germany will get caught by surprise in a very negative way. If the German economy is impacted, the entire European economy will collapse too. And look at this economy minister. Doesn't look happy, doesn't he? He looks like he just got caught sexting with a 15-year-old. But anyways, what alternative do the Germans have beside Russia and the US? Because that's a no-go. They got Qatar. But there's a problem with that too. The folks in Qatar are saying, if you want us to supply you with liquefied natural gas, you gotta sign long-term commitments. Why? Because they have to invest in facilities, they have to pump more. That costs a lot of money. They have to place orders for vessels from Korea. That takes years to build for these ships. And Qatar is saying, if we're gonna make all of these investments, it better not be for the short run. It better not be for a short spike in demand by Europeans. It better be for a long-run commitment. But here's the problem. If the Europeans indeed commit for long-run agreements with Qatar to supply them with liquefied natural gas, number one, it's going to be costly. It costs more versus just pumping natural gas, clean natural gas, via pipelines, meaning that is an additional burden on the European economy. Even in the best case scenarios, they're going to pay more for liquefied natural gas. Number two, receiving natural gas in liquefied form being shipped via vessels is actually destructive to the environment, and it defies the purpose of using natural gas as a clean resource of energy. The EU is making massive commitments for the environment and the green whatever. If they sign long-run agreements to receive liquefied natural gas via ships, which is proven to produce more pollution, significant amount of pollution. That goes against their so-called values. Number 3, the entire purpose from this war, the Ukraine war and the whole thing we're doing with Russia, with the sanctions and yada, 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 is for the U.S. to grab market share from the Russians, to replace Russian natural gas supplies to European countries with American ones, aka making more money. So if the Europeans sign long-term agreements with Qatar, effectively they'll be backstabbing the United States and defying the entire purpose from this war. Anyhow, back to the futures before we get in trouble for revealing the truth. What about softs? Down across the board on Friday, and the declines were led by cotton once again, down over 4% on Friday alone. Massive declines for cotton futures as of late. And this is good news if you want to buy underwear, because the way the economy is going, you're probably going to need them. But besides cotton, we got declines, big ones, for coffee of over 2.5%. OJ was down almost 2% on Friday. Then we have more modest declines for lumber, a little over half a percentage point, and sugar futures also down almost half a percentage point on Friday. The outlier is cocoa, be it up modestly. What about metals? What's going on here? No major move in the US dollar, even though we're seeing the yen collapsing, even though the yen is kind of, in my opinion at least, getting closer and closer to a bottom. Matter of fact, I bought a bunch of yen last week, not just for buying the bottom in the yen, but to take advantage of the exchange rate in case I have to travel to Japan, which could happen probably by the end of the year. But in any case, in the meantime, until the US dollar makes the next move, metals are not moving, muted activities for gold, silver, platinum, copper, not moving at all, while we have a recovery in palladium. Palladium is well below the highs, but it rebounded higher on Friday by a little over 1.75%. When it comes to meats, it was a down day for feeder cattle futures, down by almost 1.5%. So was live cattle futures, be it down modestly. Yet the winner in meats is the new big tech lean hogs futures, scoring gains of about 3% on Friday. Grains, we've seen massive declines in grains in the last 2 weeks. Yet on Friday, we got a rebound at least in corn, soybean oil, soybean meal, soybeans, all scoring decent gains. Yet the decline in wheat continues, down almost 1.25% on Friday. A big down day for oats, down by over 3.5% on Friday alone. And therefore, you're seeing the agriculture trade kind of softening. Fertilizers are down big. The agriculture names, Deere, ADM, all down big since we've seen the top, at least for now, in wheat, corn, soybean, etc. And on Friday, we got muted activities, no major moves for both rough rice and canola futures. Now, why did corn and soybeans stop? In my opinion, the reason is the Brazilian output, which came out a lot better than expected. Matter of fact, record crop for both corn and soybeans. So that alleviates the food shortage for now. The problem that we got is wheat, and for now, nobody's substituting the shortage of wheat. Moving on to the big casino, the options market. What's going on here? On Friday, we're seeing more activities. We talked about signs of a bottom. The dollar goes down, the 10-year goes down, oil goes down, but we also need to see some retail activity, not just the usual dip buying that ends up being catching a falling knife. We need to see activities in the options market, buying calls aggressively. Are we seeing that? Perhaps the beginning signs of that, because on Friday the volume was higher than the prior days, and there was more buying of calls than puts. At number one, the hottest table on Friday was Tesla. At around 1.5 million contracts traded for the name, about 54.5% of those were calls. We used to see puts outweighing calls. Now we're seeing more buying of calls, and this is a good sign that we might have a relief rally inside. At number two, Apple. At around 1.5 million contracts traded on Friday, about 65% of those were calls. At number three, Amazon. At around 1.2 million contracts, about 61% of those were calls. The put-to-call ratio is improving, no doubt about it, and this is a good sign for the bulls. Now, what about the unusual activities that took place in the options market on Friday? We start with the ticker IWM. This is for the Russell 2000 small caps. They're buying puts already, fading the rip. In this case, they bought the 166 puts for the expiration date, August 19th, with expectations that the IWM could go down by more than 5% by then. They paid around $5 a piece to enter this trade, all in all, spending around $7 million. And then we have the trade for the ticker XLY. This is for consumer discretionary. This is the ETF. It's down about 30% for the year, but somebody's betting for a rebound. And in this case, they bought the 160 calls for the expiration date, August 19th, with expectations. The name could move higher by more than 9% by then. And watch out here if you're going to follow this trade because the spread is wide, at least for now. But they paid around $3.50 a piece to enter this trade, all in all, spending around $3.5 million. Now, what about the trade for the ticker QQQ, the NASDAQ? They bought calls this time around, so the contrast in sentiment is really interesting. They're betting against the IWM, but they're buying the dip in the Qs. One of these two is going to be right. Anyhow, for the Qs trade, they bought the 314 calls for the expiration date, August 19th, with expectations that the Qs could rebound higher by more than 6.5% by then. They paid around $6 a piece to enter this trade, all in all spending around $5.4 million. Continuing with interesting trades, what about the ticker CVNA, Carvana? Down big from the top, they bought the dip here via call options. I did the same, by the way. We'll talk about Carvana's chart in the charts analysis, but in this case, they bought the 37.5 calls for the expiration date, July 15th, with expectations that Carvana could rebound higher by more than 19% by then. They paid around $2 a piece to enter this trade, all in all spending around $1.4 million. And then we have the trade for the ticker XOP. This is the oil ETF. Somebody's buying the dip here, not buying the peak inflation or the recession argument. They're saying this is a mere correction in the XOP. They bought the 135 calls for the expiration date, July 15th, with expectations that the XOP could rebound higher by more than 10.5% by then. They paid around $2 a piece to enter this trade, all in all spending around $1.5 million. What about the ticker EQT, another gas player? It has been an outperformer big time year to date, but recently after the Freeport facility problem, all natural gas stocks are down, including EQT, but somebody's buying the dip here by buying the 41 calls for the expiration date, August 19th, with expectations that the name could rebound higher by more than 17% by then. They paid around $1.75 a piece to enter this trade, all in all spending around $1 million. Now, what about the trades for the ticker ARKK for Tesla, which Cathy Wood? I'm going to go in depth here, but you got to understand my assumption here because there are multiple ways to read this trade. You can actually read them separately. There is a put spread and there's a entirely different trade for the calls. But I read them as connected, as a trade of three legs. Why? Because that could be the case, but on top of that, we can learn more if we do in-depth analysis with the assumption that this is a three-legged trade. But let's back up here for a moment because a lot of you say, history doesn't repeat itself, bro. You don't know what you're talking about. It's different this time around. Really? History actually repeats itself. It's the same thing. It's déjà vu all over again. We're just different players, folks. You think we're not going to have a World War III in 1940 around that time? Think again. But history repeats itself in many ways. In this case, this is the chart of the ARKK in pink. Right now, 2022. And below that is the chart of the NDX, the NASDAQ 100, at the time of the implosion of the dot-com bubble. These charts look identical, almost, to the penny. So again, history repeats itself over and over and over again. And folks never learn. They always say this is going to be different. It's going to be different this time around. No, it's not. It's exactly the same. And every time folks bought the dip after the crash in 2000 in the NASDAQ, they caught falling knife after falling knife after falling knife, and it lasted for years before the NASDAQ found a bottom. And the assumption here that the ARKK will not be any different. We will see more catching of falling knives, and it's going to be really frustrating, and at some point we might see a bottom. Although in this case, we could see the entire implosion of the ARKK, the end of Cathy Wood. A lot of things could go wrong, and this entire fund could go bust, aka ARKK goes 2.0. But here's the trade, so we can talk about it in details. We got 2 days in the calendar, July 15th and July 29th. For July 15th, that is the expiration date, the trader bought the 52 calls at the cost of $1 a piece. At the same time, they sold the 43 puts. They received credit of $2 a piece. All in all, they received $2 from selling the 43 puts. They paid $1 for buying the 52 calls. All in all, they have a credit of $1 apiece. And this is for the trade, the leg of July 15th. Then, for July 29th, they bought the 40 puts at the cost of $1.75 apiece. Now, when you factor in that they have $1 worth of credit from the leg of July 15th, all in all, the entry cost for this trade entirely is $75 apiece. So what are they doing here? Here it is. They're betting that the ARKK could jump higher by a minimum of 15.75% by the expiration date of July 15th, 2022. Because if the ARKK jumps higher and closes above 53 by July 15th, then the 52 calls that they bought, they spent $1 a piece to buy that, will be in the money, meaning making profits. At the same time, keep in mind that they sold the 43 puts for the same expiration date of July 15th. What does that mean? What does that say? It says the trader is confident that in the short run, we will see a rally in the ARKK that will get us at least above $53 a share, meaning that selling the 43 puts is risk-free if you have that assumption, because by expiration date, that 43 put will be out of the money, meaning they're going to capture the entire credit from that trade. In other words, it doesn't matter whether the ARKK actually closes above 53 or not, so long as it closes above 43 by July 15th, 2022. They're going to keep the credit of $1 apiece. Now, if the ARKK shoots up higher, above 53, and closes there by July 15th, then that's the cherry on top. Because whatever profits above 53, that gets added to the credit of $1 apiece from selling the puts. And the assumption now that the puts expired worthless. But here's the next assumption from this trade. The trader says after that initial pop higher, the ARKK will go down and make lower lows. Matter of fact, it's going to be below $40 a share by the expiration date of July 29th. And therefore, they bought the $40 puts for the expiration date of July 29th. Now, bear in mind, this is a complicated trade, meaning even if the ARKK doesn't go below $40 a share by the expiration date of July 29th, if the ARKK closed the week of July 15th, let's say at around $55, $56 a share, then the trader is making profits, big time. And it doesn't matter if the second leg of the trade becomes profitable or not. And therefore, I do like this trade a lot. There is a risk. What is the risk? The risk is if the ARKK goes down below 43 by the expiration date of July 15th. But even if that happens, the trade of buying the 40 puts for the expiration date of July 29th will appreciate in value and will cover for the majority of losses from selling the 43 puts with the expiration date of July 15th. But the ideal scenario is the following. The ARKK moves higher. It reaches, let's say, 55, maybe above 55, at some point before July 15th, the expiration date, and the trader books profits from the 52 calls with the expiration date of July 15th, and then the ARKK closes above 43 by July 15th, and hence the put option, the 43 put options that they sold expire worthless, and they get to capture the credit, the entire credit. And then, after July 15th, the stock starts to trade down and it closes the week below 40. That will be the maximum profit from this trade. But that's not the only scenario where this trade can be profitable. And therefore, I do like this trade and I believe it is absolutely brilliant. Anyhow, let's move on to the heat map analysis. What's going on here? A sea of green with no exceptions. Even energy and materials participated in the action on Friday. So nothing to see here. We have algorithmic activities of buying, perhaps some inflows by the retail crowd, by the institutionals, and that was the tide that lifted all boats. Now, when we contrast this with the weekly heat map, we can see that everything is lining up green with exception of what? With exception of the recent winners. Energy, agriculture names, the material names, the defensive names, ADM, a farming name, Caterpillar, Deere, the outperformers in industrials that are related to farming anyways. So this is a bet against commodities. We are seeing a rotation to the risk-on corners of the stock market. We're talking about technology, we're talking about communication services, we're talking about cyclicals. But is that going to last? Is it sustainable? That is the $1 million question. In my opinion, we have to look for consistency. And the consistent outperformers, even when energy and commodities were outperforming technology and communication services and cyclicals, were healthcare, specifically big pharma names, utilities to a certain extent, and REITs. So for now, do you buy the rotation out of commodities, technology to communication services and cyclicals, or do you stick with the consistent performers of the big pharma names, REITs, and utilities, and perhaps even the defense contractors, Lockheed, Northrop, Raytheon? They've been consistent outperformers even when commodities were trading higher and technology was trading down. So you got to pay attention now to what I'm saying. If you are an investor, if you're buying the dip as an investor, you got to stick with the outperformers. You got to stick with the consistent outperformers, the big pharma, REITs, utilities, maybe the defense contractors. But these could go down if we have a truce between Russia and Ukraine. So keep that in mind. On the other hand, if you're a trader and you're looking to take advantage of this rotation, maybe it's going to last for a little more. Maybe we'll see more action in technology, communication services, and cyclicals. Then yes, you can buy call options in the most oversold names in these categories. But keep in mind that whatever rally we get in these names will be temporary, a bear market rally. Now the question is, do you buy the dip in commodities, in energy stocks, in agriculture stocks? I think you should wait for a little bit because I tweeted this on July 10th and I said that I sold all of my agricultural stocks and I explained why in the previous video. I also sold half of my Chevron, my gas names, Coterra, etc. All of the names that were in my portfolio are gone. I'm not going to buy again until I see clear signs that what we got in the last couple of weeks in the commodities market, the massive drops, is not due to a fear for recession, that we're not there yet. It was just a mere correction for whatever reason. Otherwise, if you buy the dip in commodities right now, and they're going down because of fears of a recession, because you have to remember, this is a leading indicator of an upcoming recession where we see oil and commodities topping and moving down. You're going to get caught catching a falling knife. Anyhow, let's move on to the weekly heat map for the ETFs. What's going on here? Green across the board with exception of commodities. Commodities are down big, be it energy, the XOP, XLE, OIH down big. Natural gas ETFs also down big. UNG, UCO all down big. BOIL, BOIL down massively. Almost 30% for the week. What's working, on the other hand? The risk-on kind of ETFs. Technology, commodities, biotech, the XBI, up almost 20.5% in a single week. That's insane. You see growth and value, both are up for the week, yet growth is outperforming value. This is yet another sign that we're seeing market participants buying the narrative, at least for now, that they should go back to risk-on mode because commodities are peaking and hence inflation is peaking. And that leads to a less aggressive Fed. This is the assumption for now. In my opinion, it is a fantasy, but you're going to have to play it for now. Another piece of evidence that that is the case is the outperformance by Chinese equities, the ETFs, FXI, MCHI, all outperforming for the week. Yet the underperformer happens to be the commodities heavyweight, the EWZ for Brazil, down almost 4%. So the evidence is clear here. The market, at least last week, moved to risk-on mode, appreciating cyclicals, appreciating technology, appreciating biotech, etc., growth, the Chinese ETFs, and some of that action came as a rotation out of energy, commodities, the inflationary trade. How long will that narrative stay? Who knows? Another piece of data negating that assumption, saying that perhaps inflation is not peaking, then the entire action that you're seeing right in front of you will reverse. Another problem. If market participants realize that commodities are not moving down because of peak inflation, but because of a recession, an upcoming recession, then you will see the entire action that you're seeing right now reversing too. So keep that in mind. Moving on to charts, and we start with S&P 500, the SPY 30 minutes chart. What's going on here? We have a gap higher forming a bull flag, which is already playing out. The good news for the bulls is the following. We have 385 for support for now, and the chart closed the day above the gap of 389.82. Now, if you're using the daily chart, it's going to be 389.75. It doesn't really matter. The chart closed above the gap. So when we talk about show me the money, the chart did indeed show us the money. It closed above 385 for support, and it closed above the gap. But there is a problem. In the 30 minutes / hourly charts, the RSI, the momentum indicator, is severely overextended to the upside. What does that mean? We should see a pullback. Now, that doesn't mean a reversal or a give back of the recent bounce because the daily chart, the weekly chart, these are not overbought or overextended at all. The correction will happen from a 30 minutes an hourly perspective, maybe going down or retest 385 once again. If we see a rebound from that point on, then you got yet another confirmation that this is for real. This is a solid bear market rally that you have to play. And that could take us all the way to close the next gap, let's say at around 408, and it could take us all the way to the next resistance of 405, and then we have 410, but we'll take it one day at a time. Moving on to the daily chart for the continuous contract for the SPY, the good news for the bulls, number one, keeping the support 3,720.5. That's number one. But not only that, the chart went higher and it recaptured the support of 3,855 and it closed the gap. It is quite unusual to see a gap on a continuous contract futures kind of chart. So that gap is closed now. And now we're looking at 3,960 as the next resistance. The volume remains below average. This is good news for the bulls. The momentum indicators are reversing course, but bear in mind, we don't have a confirmation yet for the MACD that this is indeed the end of the bearish momentum and the start of a new bullish momentum. We might get that confirmation overnight. We might get that confirmation by the end of the day tomorrow. But for now, we don't have that one confirmation that the bulls need to feel safe. Moving on to the SPX, the cash index. This is a daily chart. We talked about the gaps that usually in charting behavior, these gaps are filled. Sometimes right away, sometimes it takes quite a bit of time, but these gaps will be closed. We closed the gap of 3,985. That's done for now. We're now eyeing the gap at around 4,017.81, but notice that around that number, we have a sloping line of resistance, which should act as stiff resistance, specifically after a massive pop if it happens in one shot all the way to 4,017.81. The assumption is maybe we'll get over there, close that gap, face the resistance, and then reverse course. This is at least what the bears are looking forward to. And the bears are supported by an important fact. When we switch to the monthly chart for the SPX, the cash index, look at the MACD indicator, the momentum indicator. It has already crossed to negative territory, producing red impressions on the histogram, indicating that this is under bearish momentum from a monthly perspective. So you can get bounces from a daily, weekly chart perspective. That doesn't matter. From a monthly chart perspective, the momentum remains bearish, and we have negative divergence on the hour side. So whatever bounce we get, eventually we're going down again. At least this is according to the monthly chart of the SPX. Here's the cues, the NASDAQ 30 minutes chart. What's going on here? We got the gap higher, forming a bull flag. That bull flag played by the end of the day on Friday. Lots of short covering here, no doubt about it. But it's also combined by inflows because the relative volume that is, was unusually higher. Now we have the resistance at around 297.5, and then we have the gap above at around 299.28. Now mind you, we have gaps below, but unlike the gaps above, the gaps below don't have to be closed. Most of them are closed, but not all of them, unlike the gaps above. The gaps above eventually will be closed. The thinking for now, looking at the 30 minutes chart, look at the hour side. It is severely overextended. So, if we have a pop in the morning, we get to 297.5, we should be expecting a pullback, at least to cool off the overextended readings in the hour side from a 30 to say an hourly perspective. Yet it wouldn't be quite out of the ordinary if we have a pullback right away before even revisiting 297.5 as resistance, because the reading is overextended as is right now. Here's the daily chart for the continuous contract for the cues. What's going on here? The good news for the bulls is the following. Number one, the support 11,689 is intact. Number two, the volume remains below average. Number three, the momentum indicators are firming up. Matter of fact, we have a confirmation, unlike the SPY. We have a confirmation in the NASDAQ from a daily chart perspective on the continuous contract that indeed the bearish momentum is over and we have new bullish momentum. If that continues, it could take us all the way to 12,766, even 13,000. As resistance. Now, the other note that I have, and it is a bragging note, notice how supportive 11,058.5 was. Matter of fact, the bottom of this move was off by about $10, which is nothing. Matter of fact, the rebound came from 11,068.5. And we caught that level, by the way, about 2 weeks ago. Anyhow, moving on to the IWM, the Russell 2000, I'm using a weekly chart this time around. Why? Because the gap below at around 163.62 has been closed, and we have a rebound for now. Now the chart is eyeing the gap above at around 178.59. The problem becomes if the IWM pierces below 163.62 once again. That would be a big problem. Because the gap is closed, the chart has no excuse not to bounce and rally higher from that point on. So if that support is broken again, it is a sign that the IWM is not ready for a rally, and indeed it is looking below for another support. And that next support will be way below at around the 140 levels. So watch out here. Next we have the Dixie. What's going on here? Waiting and waiting and waiting for the next move by the dollar index. The bears would argue, look at the MACD indicator. We're about to have a negative crossing. Sooner or later, the Dixie is going to lose 103 as support. That would be a confirmation that the rally in the dollar is done, yet dollar bulls are going to counter with this. What if this is a cup and handle formation? And sooner or later, the dollar is going to pop higher again. We're not going to know until we see the next move. Moving on to gold, what's going on here from a daily chart perspective? Not looking good, even though it is consolidating for now. but it lost an important support, the Fibonacci support at around 1,845. It formed a lower low. All of these are not good signs for gold, but it all depends on the movement of the dollar. If the dollar is going to go down for whatever reason, doesn't matter what the reason is, gold will appreciate higher again, regardless of the technical formation. But you got to bear in mind, when we switch to a monthly chart of gold, we have what it appears to be a double top. And if that plays out, then gold could go down another, about 15% from this point on. And you're going to know that for sure once the Fibonacci support of 1,750 is broken for good. Then you know we're going down to the next support at around 1,550. Moving on to Brent crude oil. What's going on here? 4 hours chart. The bear flag played out, yet we got a rebound. It got us all the way to 114. Pretty much to the penny, and the chart stopped right there and then. Now it is trading as I'm speaking, but I'm not looking at it. Here's my assumption. The bears would argue that this is yet another formation of a bear flag. Sooner or later, this is going to play out, and we will see crude, in this case Brent, going down all the way to the next support at around 106. In my chart, it is 105.84. But the bulls would argue, not so fast. What if this is the beginning of formation of a reverse head and shoulder? You got the left shoulder, right shoulder, whatever it is. We got the head, and now the chart is forming the next shoulder, which will play out and take us all the way above 114. Not only that, but above 118 once again. Here's the 10-year yield, the daily chart. What's going on here? We got the top at around 3.5, pretty much exactly to the penny, forming a bear flag. And now the chart went down, reaching the support at around 3%, but we got a little bit of a rebound on Friday. We look at the MACD indicator. We have bearish momentum. Not very strong because the red columns that you see in the histogram are short and shy. What does that mean? At any point right now, the 10-year yield could reverse course and pop higher again. You're not going to feel safe until 3% is broken as support, but even if that happens, we must ask the question, are yields crashing for the good reasons or for the bad reasons? The good reasons means support catching up with the demand, and hence inflation is peaking. The bad reasons would be expectations of a recession and Fed's easing at some point. If that is the case, regardless if it is for a recession or no recession, the TLT will move higher again because we will see buying of bonds. This is a weekly chart of the TLT. It got support at around 109.5, but we got a rebound for now. It is not a decisive rebound. It is not a confirmed rebound because we don't have a signal from the MACD indicator. Once the MACD crosses and we see green impressions on the histogram, then we got the confirmation that the TLT is about to conduct a massive rally higher. The VIX, the volatility index, what's going on here from a 4 hours perspective? The VIX lost two supports, closing the gap of 29.61 and then closing the gap of 27.77 and closing the day and the week below that support. Is this action bullish or bearish? The answer is it is bearish, no doubt about it. But can the VIX stage a rebound from this point on? Yes, it could. Look at the RSI indicator, for example. It appears that it wants to reverse course and move higher again. So is the MACD indicator. This is all from a 4 hours perspective, of course. You'll know that the VIX is moving higher and hence the SPY is done for good, that this is all there is in this rebound if the VIX recaptures 33 once again. That's a long way from now. So you could see the VIX recapturing 27.77. You could get excited and say, okay, this is it. The SPY is done. And then you get a massive pie in the face. The VIX loses 27.77 again, and the SPY rebounds higher after fixing some overbought, technical indicators from a 30 to an hourly chart perspective. Therefore, the VIX has to pop above 29.61 and reconfirm that as support. Not only that, but go all the way back to 33 before we have clear indicators that we have a reversal in the SPY, a confirmation that this is all there is in the SPY's bounce. Likewise, here's the VXN, the VIX for the NASDAQ. This is a 4 hours chart. Unlike the actual VIX, we're seeing relative strength from the VXN versus the VIX. It did not even break the gap support at 32.72. Yes, we have negative bearish momentum on the MACD indicator from a 4 hours perspective, but it is not decisive yet. At any point, the VXN could reverse course and move higher again. The confirmation, though, would be the VXN recapturing 40 as support. Then we'll know that the bounce in the cues that we got last week is all there is. Here's Apple, a daily chart. What's going on here? The good news for the bulls: number one, recapturing the support of 138.79, and the chart is now eyeing the resistance at around 145. Also, the volume went higher on a buying day on Friday. This is a good sign. The MACD indicator from a daily chart perspective is flashing green. All of these are good signs. But here's the problem. Let's clean up the chart a little bit. same chart, daily chart, we have a sloping line of resistance, and we have a series of lower lows. The assumption is, the bullish assumption, that Apple could crack above the resistance line, then it goes down in a retest. This would be an ABC pattern. What we're seeing right now is the A leg, then the retracement back to the sloping line of resistance. At that point, it would be support, is the B leg, and then we see the bounce higher, forming the C leg. This is at least what the bulls are hoping for, but the bulls have another scenario in hand. What if the break doesn't happen and Apple goes down, yet it forms a higher low? This remains a bullish formation, indicating that at some point the sloping line of resistance will be broken, so long as the series of higher lows remains intact. But the bears are hoping for another scenario, that Apple will face resistance from the sloping line, and then it's going to go down, forming a lower low. Once the chart cuts below the last low, we're going to have declines until we see the next low. That would be a shorting signal right there and then. Moving on to Tesla, the souffle. What's going on here? This is a 30 minutes chart. The head and shoulder formation played out briefly. It got us below 700, but the buyers showed up again on the heels of the action that we got from Tesla Whale earlier in the week. Now, who is Tesla Whale, you might ask? Older viewers of this channel are familiar with the famous Tesla Whale trader who buys an insane amount of call options of Tesla earlier in the week, and then he dumps by Wednesday, Thursday the most. And this is exactly what we got this week. We got the pump, then we got the dump below 700. But this time around, the dip buyers showed up and followed on the heels of Tesla Whale, and it got us all the way to the highs again, forming a bull flag pattern. And yes, the RSI is slightly overextended, not anything severe at all. But if it pulls back, the test becomes, is the chart going to keep 700 as support or not? But if the bull flag continues, we have the next resistance at around 766.5. This is at least from a 30 minutes chart perspective. But the bulls are also playing a different game. They're playing the daily chart perspective too. They're saying, okay, the chart pierced below 700, the most important support, but the chart formed a double bottom formation. It is not overbought or overextended by any means from a daily chart perspective, technically speaking. And if the double bottom formation plays out, it's going to get us all the way to closing the gap at around 865.65. I say this is a long shot, but it could happen under the right conditions. Next, we have BTC, Bitcoin. What's going on here? Forming the bear flag, still no action whatsoever that tells us that Bitcoin is moving higher again. And the longer the chart waits for buyers and the buyers don't show up, the riskier it becomes. The possibilities of piercing below 20,000 become more likely again. So unlike the Qs, the SPY, where we asked for the charts to show us the money and the charts showed us the money, Bitcoin is not showing us the money at all. Therefore, I'd rather be in equities than in cryptos if I'm playing a rebound rally. And here's the question from the viewer. He says, hey Maverick, love your work. What is your honest take on Bitcoin? Do you think it will eventually go down to zero? I think the zero predictions are outlandish. They're exaggerated. They get a lot of headlines, a lot of attention, but they're not really realistic because there is a value of Bitcoin. It's not going to go down to zero unless we have a systemic risk that plays out. Then we could see Bitcoin down to zero. But for now, all what's going on is removing the fluff that took place in the bubble of 2020, 2021. That's all there is. Meaning getting rid of these speculators, which should and could get Bitcoin down to 10,000. Now, if the sell-off gets exacerbated by, let's say, margin calls, for example, or other mechanical factors, then we could see Bitcoin going down below 10,000, maybe in an excessive way, down to 8,000, 5,000, 2,000. But 10,000 is the consensus where Bitcoin should be trading at after removing all the fluff from the bubble of 2020, 2021. And lastly, here's a thought for you. If we have a rebound rally, a bear market rally, even under fake assumptions of peak inflation, commodities going down, Jerome Powell doesn't have to be as hawkish as we thought, yada, yada, yada. We know they're going to be wrong in the long run. But in the short run, what if that plays out and we have a big rally ahead? You can play that via the most oversold charts out there. For example, the weekly chart of Carvana. Way oversold. Look at the RSI, the MACD indicators. And it appears that we caught support at around 22.16. Now, the insiders who dumped at the top, by the way, are now buying shares again. We have a mini confirmation that the bearish momentum in Carvana that started back at around September, October of last year is now coming to an end. Now, that doesn't mean that Carvana will pop higher all the way to all-time highs under bullish momentum, but it means that the worst is behind us for now. We could see a pop higher, sometimes big pops, 10, 20% per day. But the best market rallies, the ones that I want to play, are the ones that happen gradually. You might remember some of those back in 2002, 2004. That means that Carvana should not move by 10-20% in a single day. I'd like to see 1.5%, 2.5% maximum, and gradually we see Carvana gaining from this point on another 16%, 20%. That would be a decent bear market rally. Another chart, for example, Shopify. This is a weekly chart, way oversold from the RSI and MACD indicators perspectives, but we're seeing the end of the bearish momentum that started last year and the beginning of a new bullish momentum. Again, that doesn't mean it's going to take Shopify back to all-time highs. Matter of fact, these all-time highs might stick for years to come, but it means that we could see a decent rally. You don't want to miss on that rally. So what I want from you is to look at your charts and find these oversold charts specifically from a weekly chart perspective. Look at the dollar, look at the 10-year yield, look at oil, and look at the sentiment. If the dollar goes down, continues to go down, if the 10-year goes down, if oil continues to be soft, and we see more talk about peak inflation and Jerome Powell doesn't have to be as hawkish as we thought, these are the kind of charts you want to play for any rebound rally. But bear in mind, historically speaking, we have not seen the bottom in this bear market, not even close. And I shared with you the arguments and the reasoning in the beginning of this video in the In Focus segment. That being said, let's move on to the conclusion of this video. What do we have on the economic calendar this upcoming week? On Monday, we have durable goods, core capital goods orders, and pending home sales. On Tuesday, June 28th, we have the most important S&P Case-Shiller Home Price Index. We also have the Consumer Confidence Index. Wednesday, June 29th, we have the GDP revisions. And then Thursday, June 30th, the most important day by far, we have PCE inflation, core PCE, which the Fed looks at. We have disposable income, consumer spending. We have the initial jobless claims, continuing jobless claims, in addition to the Chicago PMI. Lastly, on Friday, July 1st, we're going to have the manufacturing PMI in addition to construction spending. With that, folks, I'm done here. This is all I got for you for now. But rest assured, even though I was absent last week, I'll be back here this upcoming week. So stick around and buckle up your seatbelts. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.